Hello, my name is Elliott. I'm the editor of the Energy Strategist, and today I wanted to talk a little bit more about a sector that I think is very poorly understood by many investors, and that's really the refining space, the refiners. A lot of people think that refining companies, whether those be part of the larger integrated oils or if they're part of actually independent refining companies, a lot of people think that refining operations benefit from higher crude oil prices, and that's not exactly true. In fact, in many cases, refiners actually benefit from lower crude oil prices. Now, if you think about what a refiner does, they're the link between raw crude oil and refined products like gasoline, or diesel fuel, jet fuel, etc. We don't burn crude oil, raw crude oil, in our cars. We burn gasoline. What refiners do is they take raw crude oil and convert it into gasoline. So if you think about it, crude oil is actually the input in that process. Crude oil is actually a cost for most refining companies. So in other words, a refiner will have to buy crude oil, and that's really the cost of their raw material, and they'll sell gasoline and diesel fuel. Therefore, refiners really profit from the spread between crude oil prices and the prices of gasoline and other refined products that they sell. So if the price of crude oil rises, it actually raises their costs and cuts their profit margins. So really what's good for refiners is relatively low crude oil prices and relatively high gasoline prices. Now over the course of the last year, we've seen really a very good time and a very bad time for the nation's refining companies. Early on in 2007, we saw refining margins, what we call the crack spread, which is the difference between the price of crude oil and the price of a barrel of refined products. We saw the crack spread really expand, which implies that profit margins for refining companies expanded very rapidly. This occurred for a couple of reasons. One reason was that the inventories of crude oil in storage in the United States were very high, particularly high in the U.S. relative to other parts of the world. So that really kept crude oil prices relatively depressed for the first part of the year. It's not that crude oil prices were rising, but they certainly weren't rising as quickly as the price of refined products like gasoline. The reason we saw gasoline prices move up so rapidly going into the summer months was that inventories of gasoline were very, very low. The main problem was that a lot of refineries in the United States had mechanical problems, maintenance issues, and had to be taken offline. A lot of you will remember we saw a lot of refining fires back in February and March. And that caused a lot of refineries to have to be taken offline, which meant that they obviously weren't refining gasoline. And that brought the inventories of gasoline in the United States to very, very low levels. So low supply of gasoline and relatively high supply of crude oil caused that crack spread to really widen. This lasted all the way up until about the middle of the summer, which is sort of the peak of the summer driving season in July sort of time frame. And we saw the crack spread start to come down at that point in time. Because a lot of those refineries that had been offline came back online, started pumping out gasoline. At the same time, we saw a really accelerated upside in crude oil for reasons I've discussed on prior webcasts, but mainly having to do with steady demand or rising demand and, of course, shrinking supply of inventories in the United States. So crude oil prices went up and gasoline prices moderated a bit, or certainly didn't rise as quickly as crude, and that really squeezed the refiners' spreads, the crack spread and their profit margins. And that's why we saw a lot of companies like Valero, Chevron, Marathon all warn in their third quarter. But here's the interesting thing. I think what we're seeing, we're setting up for the new year. The refining sector is going to be a place to really watch towards the end of January. The reason I say that is typically, seasonally, that's when you see these crack spreads really bottom out. And in fact, this year I think we may have gotten that a little early. I think crack spreads might have already bottomed out. And I think that I talked on prior webcasts about why I think crude oil prices might moderate a little bit. And I think we're going to see that bring the price of crude oil down, or at least moderate the price of crude oil a lot. That will help the refiners on the cost side. At the same time, gasoline inventories remain ultra tight. So I think there's room for gasoline prices to rise, and that will really increase the crack spreads for the refiners. Thank you very much for joining me today, and I look forward to doing another one of these webcasts in the near future.